of course, we came to get away from the Canadian winter and to look for a lower cost of living. But there was one more reason why we chose Lakeside, and that's because there's just a lot of wonderful activities in this area. A lot of people have been in this community for decades, building a community and giving us a lot of things to do. So this area is rich with culture. As we settled in, I began to think about what I would like to do with my time in retirement, more than just put my feet up, and become familiar with the community and think of a way to make a contribution. So we're benefiting from the people before us. What can we do to contribute to building up this community, to make a good community even better? My passion is non-fiction books. I love to read, I love to learn, and I discovered there is no book club in Lakeside that specifically focuses on non-fiction. So I started a club. Ahihi Book Club launched about a year ago. And we already, after a year, we're a viable book club. We have a strong core of members. At our first meeting with a featured book, I had by that time met Prins, and I'd become familiar with his book, One Step Ahead. And at the meeting of the Ahihi Book Club in September 2016, a year ago, One Step Ahead was our featured book. At that meeting, I talked about some of the vision I had for the book club, and I thought it would be nice if we could attract to the Lakeside area an author with some renown, not local. Jack is local, we've had other books that are local, but what if we bring somebody who is not local and do an event like this? So the idea for this, I first mentioned over a year ago, and Jack said, I know somebody. I think I can get her to come to Lakeside. So he made me aware of Nomi. I began looking at her website, and I thought, perfect, I really liked what I saw. But I had a challenge because the Ahihi Book Club was new, and I knew we couldn't pull this off by ourselves. So I began to think about who could we partner with, and first come to mind was Democrats Abroad. So I reached out to Didi Kamhai, and we had breakfast, and I pitched her my idea, and she liked it. She said, yes, John, we can do this. I'm on board. Thank you, Didi, because that was critical. We could not have done this without Democrats Abroad. We could not have done this without Didi's support. Where is Larry? Didi is not going to come to the mic, but Larry Beale is. He's going to say a few words on this side, Larry. We have really nice steps for you on this side. He's going to say a few words on behalf of Democrats Abroad.
Thank you very much, John. By the way, a brief announcement. There is a fellow trying to get out of his garage at the end of this street. Anybody has a green Honda Fit, if you move it for 1 second, he can get out of his garage and you can put it right back. So if you have a dark green Honda Fit, thank you. You didn't come to listen to me talk, so I'll give you a less than 1 minute spiel. Democrats Abroad represents Americans living overseas, and our primary purpose is to help people get registered and get their ballots. We also hold other events similar to this. Hopefully you have some intellectual content, maybe some political content. We have regular monthly meetings, normally at La Bodega restaurant. This is an off day, but it's normally the third Monday of the month? I thought it was second. You could tell I'm a past chapter chair. Anyway, so you're all welcome, Canadians and US alike. We are going to be this year putting a big push on helping to find Hispanic U.S. citizens living in Mexico. There is a lot of them. There's as many or more here than there are the non-Hispanic Americans. So we're hoping to have some impact on voting in the States. I want to thank, first of all, Roy Nolan. Those of you that know him, he's been very generous in volunteering his excellent videography skills. He's a world-class videographer, and we'll make this presentation available to other chapters of Democrats Abroad all around the country. So anybody that would like to be a member, there's no charge to it. There are flyers here you can sign up, and we'd love to have you join us, and we'll help make sure you get your ballot when the time comes. Thank you all for attending. By the way, I should mention in the back, raise your hand, Ilona. Ilona is the new chapter chair for this chapter. So Ilona de Baghehi. And I told you it was the second Monday. Thank you.
Thank you, Larry. There's a few more people that we need to thank before we get into the meat of the program. I'd like to thank the Progressives for their support, Chad Olson and Mel Goldberg. Thank you for your support. I would like to thank Carol Kaufman, who wrote a very nice article that was featured in the Guadalajara Reporter and gave us some additional coverage. Sandy Olson, who mentions the Ajijic Book Club regularly in her Lakeside Living column in El Ojo. I was going to thank Roy, but I won't bother now. I'd also like to thank Marianne Carlson. I don't think she's here, but she did our graphic design for us without any charge. And all she asked is that I mention her event, La Ferreria Maestros del Arte, which is the art festival. Sorry, Carl, my Spanish is terrible. You can say it properly when you get your turn. Anyway, the art festival, as we know it, which is November 10 to 12 next month. And I'd also like to thank the Ajijic Book Club members for their support. It's just been a wonderful year. The people that I've met, the connections we've been able to make around the theme of nonfiction. So that's our contribution, and our club keeps growing. We're now worrying about space. I also want to thank Antonio Enciso Ibarra. He's standing over there in the red shirt. He's trying to make his contribution with this new venue. He's putting a lot of effort into it. He has made the venue available to us free of charge. It's his bar and his kitchen, so I'm encouraging you to buy drinks, and he gave me the food that is available. So they have guacamole and chips, chicken broth and vegetables, chicken fajitas with rice and beans, breaded chicken breast, beef or chicken hamburgers, and some tacos. And I see people are already availing themselves, so that's good. So again, I encourage you to give him your patronage and spread the word about this facility. He's trying to get the word out. I've been to 2 events here now. There was a turkey dinner here yesterday, so word is getting around, and we will spread the word to get him noticed on the map. Okay, now to introduce our speaker today, I'm going to ask Jack Prins to come to the stage.
I know Nomi for a long time. I met her when she was a little tight. She was an excellent student in kindergarten. It was a good beginning. Nomi had the gift of understanding what I told her or explained, and you don't see this often. It was a good beginning again. She became an outstanding student in elementary school. Then, at a certain point in time, as many Americans do, or most people, I worked for a living, and that was IBM I worked for. I got a postdoc, and that was in IBM, was in Weizmann, in Israel. So we went to Israel with the whole family. And for those people that know Hebrew, mit de ganze mispogen. And so, what had Nomi to do? She had to switch from English to Hebrew. Hebrew is a nearly impossible language. You write it from right to left for one thing. You pronounce it totally different. It has no vowels. Everything is more and more difficult. I know that. I was in the army there. And they told me very quickly what the difference was between left and right. So, in Israel, she actually amazed everybody around her by A, going to high school, B, speaking Hebrew fairly fluently in a very short time, and C, and here it comes, she graduated high school and got a high school diploma. Okay, most of us do that, but in America, and we don't really excel in knowledge, but Hebrew is very difficult, and they teach you everything can be taught. And so she had the diploma, and with all that, she enrolled in New York State. We went back, and she went to university and graduated in math. And then she got a job working for, believe it or not, IBM. And wonder. And then once I called her over after a few months, how are you doing? And she says, well, not too bad, on page 44 of the poem book, indicating she's sort of bored. And indeed, she did the impossible. She quit IBM. People don't do that. But she did. And she went to work for Chase. And there, she also went for her master's in statistics. Most people don't know what that is, and it makes two of us. And she got a master's in statistics, quit that job, and switched over well, actually, she went to England. And in England, she went to got a job with Bear Stearns. Found England quite nice. Her team was Manchester United. No, it was not. Could be Arsenal, Chelsea. It was in London. Tottenham Hotspur. So anyhow, she was there. And after a while, somehow, for reasons that I don't have to go into, she went back to the United States and went to work for, don't boo too loudly, Goldman Sachs. No longer a friend of anybody. And Goldman Sachs, she started to think, this is really not my call in life. Kept on going to school, went to the same school I used to go to, NYU, and then found that maybe this job at Goldman Sachs is also not my life goal. And did the impossible thing again, quit Goldman Sachs. All that is an 8-figure income per year. And so, after all that went on, she decided to quit and write a book. Her first book was a fairly substantial book in economics called Other People's Money, which is actually a movie by Danny DeVito, and there is some correlation between the two, but I don't know exactly how much. And so, therefore, she wrote this book, and you could see where her thoughts were, because on page 4, I believe, of chapter 2, she was just wondering out loud, how come that we do so little and we get so much money? At Goldman Sachs, that is. And she then decided she doesn't want to be involved in petty politics, in people telling her what to do or what not to do. And so she became an author, and she wrote a whole flock of books. And they're all in Google, you can almost look at that. And after the 12th book or so, she then went into journalism. Now, for these people who aren't familiar with, say, Bernie Sanders, she worked as Bernie. And she came called not Mr., but as Bernie. I have to say Mr. Bernie. But then she worked as Hayes in the MSNBC, and a whole lot of other things. And she became well-known and well-trained, and that is where I'm going to stop now, because you will hear the results and the fruits of her labor in a second. So thank you very much. Here's Nomi.
There was a moment there where I was going to also sort of roll onto the stage to prove that we're actually genetically related, but I think you'll have to trust us. I've known my dad for a long time as well. Just wanted to let you know that. I just thank you all for coming out here today. This is amazing. We were wondering yesterday, like how many people would be here, and none of our estimates really approach the number of people I see here today. So that's really amazing. You have an amazing community here, and you know what John's done is lovely. And Lon, I have to tell you a little story about your community in a second. I will get to you. And Antonio, thank you so much for giving us this space free. We all need to drink a lot after this, and you may really need to. So that could be good for him. But just, you know, I was me and my boyfriend Nigel, who was in the front here, taking photos and videos of this. We came into town first day. We're trying to exchange money. We're walking around the center, and we don't have our passports and IDs on us because, I mean, I had a cash card to take out money. He had dollars, and we were just going to go to a bank and sort of exchange it. But yeah, everybody's shaking their head. You can't do that. We didn't know that. I've been coming here since my dad moved here, which he promised to do after George W. Bush was elected, the second time in 2004, and he did. And now we look back at those days with just such nostalgia, given what we have now. Like, oh, if only. So we're at the bank. We can't exchange money, and we see this really cute little dog. Little brown dog, very, very sweet. Comes up and just says hi, and there's a woman attached to the dog who we don't know. She's there with her dog, and we're looking around. We start to chat, and can't get the money exchange. And we ask her if she wouldn't mind, because she's known at the bank apparently, to help us out and exchange some dollars into pesos. So she says fine. We do the transaction. We get the $200 into pesos and start to chat. And it turns out that she is one of the organizers here of this event, which completely random. But I mean, this is the kind of place that you've all selected appropriately, and has that kind of a community. And so that was kind of the start of our visit this particular time, and that was really nice. So thank you. I don't know where he went, but so what I wanted to do, because this is a combination of a book club and Democrats abroad, so my books do cover politics and economics and finance and sort of global events as well as domestic events, so pretty much a lot of things. So I wanted to just go through a little bit of the history that was in my last book, All the President's Bankers, with you, to sort of give you a sense for how I analyzed the various archives and the library documents of the presidents of the United States, going back to Theodore Roosevelt and through Barack Obama. I will then also discuss my opinions on our current person in the White House. And also just from within that, give a sense from a financial perspective, where we're at economically in the U.S., how that has impacted people living in the U.S., people abroad, the world in general, and sort of where we go from there, which kind of, and you're sort of the first audience in a way to hear this, because my next book, which is called Collusion, How Central Bankers Rig the World, won't be out until May. So every book I do sort of has a connection to the prior book. And that book looks at what has been the result from a policy perspective globally of what I wrote about in All the President's Bankers in my last book. So I wanted to talk to you a little bit about that as well, and how that relates to where we're at now, how central banks and private banks have effectively colluded to work on the current policies that prevail throughout our economies. And also talk about something that I've also developed, which is that I also have a newsletter that I just started, which is called Dark Money Millionaires. But the idea of dark money is really what my dad started to sort of talk about regarding my preference to leave Goldman Sachs and the kind of huge amounts of money that people were making in the industry back then. That was in 2002. To what has transpired since, between the financial crisis, the global crisis, the current politics in which we find ourselves today, and where I see us going. And dark money is kind of a compilation of that flow of funds from sort of the elite institutions and individuals that aren't necessarily elected, they're just selected, but that have an outsized impact on economics, on finance, on retirement money, on pensions, on people starting out, on student loans, and basically the gamut of financial instruments. And so dark money is kind of how a lot of what we don't see from a money perspective is created, accumulated, where it goes, and trying to sort of unpack some of that so we have a better sense of how to protect sort of our money, as well as understand the dynamics of how that works sort of in the shadows. So I'm going to try to cover all of that, but I also want you to know that we're going to do a Q&A at the end, so if you have questions, let me know them at the end. I mean, this is obviously a group of people that know each other very well, so I just want to feel like, very communal in terms of what we talk about here today, not just what I tell you, but what you ask and what you have to say as well. So I'm going to go back in time to the beginning of All the President's Bankers, which was about 1907. And in 1907 in New York City in the United States, there was a panic. There was sort of one of the first major financial crises of the 20th century. And it started in New York. It started because a bunch of sort of small-time traders wanted to bet on the price of copper. They wanted to do something called cornering the copper market. They wanted to buy a lot, and wait and get everyone else in and in and in. And at a certain point, they were going to sell at this very high level, and whatever happened after that, however the price fell after you sell, which is what depresses prices, then everybody would, be screwed, but that would be okay because they would make a lot of money. The problem was they didn't understand that people might start to get word of their plan if they were a little too greedy along the way of accumulating their buying of all this copper, which is what happened. There were two brothers were on their way up to buying lots of copper. A couple other companies and traders got word of this, and they're like, you know what? We're going to sell right now, and we're going to screw the people who are trying to screw us. And that's basically what happened. But in the process, of course, when you have these what I now call dark money forces, but when you have these people sort of competing against each other in a speculative environment where there aren't a lot of transparent windows into what's going on at any moment, and of course in 1907, I won't say there were less, but they were different. When the word got out, one of the guys who was involved, a man named Charles Barney, happened to also run a regular bank for regular people, and it was called the Knickerbocker Trust Company. Back then, a lot of banks were called trust companies. It changed, but that was one of the ways in which it was grown. It was one of the largest banks in New York, one of the largest banks in the region, and it happened to contain the money of a lot of people in the sort of lower to middle class income levels at the time. So a vast part of the population that wasn't involved in big trading and big money, just sort of regular people. But when they started to hear that the president of the company was involved in this copper trade going wrong, they were like, well, we want to get our company out of the Knickerbocker Trust Company, because if we don't get our own money out now, we're never going to get our money. We're never going to see our money again. This was before there was a Federal Deposit Insurance Corporation, the FDIC, which was created under FDR in 1934 to protect people's deposits. There was no protection. If a bank went under, your money was just gone. And so there was lines outside of Knickerbocker Trust, all their various offices throughout New York City. There were police officers fighting with people trying to get their money. At the time, they didn't shoot people, they had clubs. But there was a lot of anguish in the street. So up in Washington, the President Theodore Roosevelt is looking at this and thinking, all right, there's a panic in the big bank in New York. I don't want there to be a panic on my watch. What can I do about this? So what he decides to do is call somebody in New York, or basically connect with someone in New York, write to someone in New York, and try to figure out a way to get some help and just understanding the situation. So he puts in a correspondence to a banker named J.P. Morgan. Now, J.P. Morgan is the most important banker in the country at the time. His name happens to be on the largest bank in the United States today, J.P. Morgan Chase, which, as my dad mentioned, was also my first employer in banking. So all these things have very long tails and lives. So Theodore and J.P. Morgan hatched this plan together, where J.P. Morgan basically gets the first bailout for banks in New York from the U.S. Treasury Department. And what he gets is $25 million, which was a lot at the time, from the Treasury Department. There wasn't a lot, there's no reporting of this. This is just happening. We know this afterwards. But he gets $25 million, and Theodore Roosevelt says, just do what you need to do. Just patch it up. So J.P. Morgan's like, well, there's the Knickerbocker Trust Company, and I don't really like those people because none of them bank with me. And there's my friends. Various banks that I do business with. So what he does is he calls a bunch of major bankers into his library on Fifth Avenue in New York City, and he says, there's going to be some problems. If this Knickerbocker thing goes down, other banks could go down, we could lose some money. So what he decided to do was parcel up this $25 million amongst them. The Knickerbocker Trust Company basically went under. Charles Barney committed suicide. But J.P. Morgan basically saved the day. And in fact, in the New York Times, about a month after this all transpired, there was a big headline article that said he was the king of the U.S. economy, J.P. Morgan, for saving the day. So didn't use his money, didn't use the Treasury's money to help the people that were most affected, and got all the credit. So that's how that started. But he was worried because this could happen again. And maybe there's someone in the White House who doesn't necessarily have his back. So he decides that one thing that should happen, and it was happening throughout Europe, is there should be a central bank. There should be some bank in the United States, some place where banks, when they were having problems, could go to get money in case they needed it, in case there was an emergency, in case they couldn't get it from the U.S. government. And that was where the sort of start of the idea of the Federal Reserve came into play. Now, there's a lot of books on conspiracies and all stuff about the Federal Reserve. But what I did was I went through just the sheer documents between the presidents and J.P. Morgan. I actually went to a place called Jekyll Island, which was where there were a number of meetings. A lot of you nodding your head. You know history. It's good. It was a really very fun part of the book to write. So the 1910s, 1920s, 1930s. But I went to a place called Jekyll Island off the coast of Georgia, which is where J.P. Morgan had a club membership, as did a lot of billionaires at the time. And they could go and get away from people generally between Thanksgiving and New Year's and take their families. Sometimes they sent their families first to sort of get them out of the way. And then they would come and they would talk about sort of world affairs and the U.S. economy and sort of their various power decisions. But before all that happened, in early November, a bunch of people under his invitation, because if you weren't a member, you couldn't go. You needed a member to basically allow you to come in to this island, went in early 1910. And the group that went was a group of politicians and bankers. They were all bankers that had some connection to J.P. Morgan, that were somewhat in that room when that $25 million was being parceled out. And they were also involved with the U.S. government from the standpoint of a man named Nelson Aldrich, who was the head of the Senate Banking Committee at the time. and also himself a Rhode Island millionaire, a senator from Rhode Island, a millionaire, head of the Senate Banking Committee. So that's no different from today in terms of his characteristics for the job. But he took a group of bankers down. They discussed this idea of having a Federal Reserve which would be there with money for banks when there was an emergency. And the formulation took a few years to become law. It ultimately became law in 1913 under the next president. There was a president in between, but under Woodrow Wilson, who was a Democrat. And under Woodrow Wilson, there was a Federal Reserve Act in 1913, which was passed, and it created an institution throughout the country, 12 different banks in the reserve system, but really headed by one Federal Reserve located in Washington, and a second one that had almost as much power and still does, located in New York. So the idea that was sold about the Federal Reserve was it would help banks throughout the country in case any of them had an emergency, but the real power bases then and now were in Washington and on Wall Street. In fact, very close to where what became J.P. Morgan Chase was a century later. In 1914, something else happened, which was the start of a world war. Now, at that point, J.P. Morgan had passed away. His son, Jack Morgan, was the head of J.P. Morgan, of the institution. And Woodrow Wilson, who came to power and tried to stay out of the war, and talking about the war is a whole other thing I'm not going to get into, but there are elements of it in the book and many, many, many other books since. But in the dawn of this Fed, because of the World War, Wilson needed Jack Morgan's help to raise money for the war. And as a result, he made a lot of concessions for the power of the Federal Reserve. It had been, after all, Jack Morgan's father's brainchild in a way, to really have even more leeway with the bigger banks, of which Jack Morgan was running one of them. So what had started out of a panic for a sort of mid-sized bank and became a sort of power concentration for the head banker at the time with respect to his relationship with Washington, kind of kept going. And it kept going through World War I. Morgan was one of the banks that raised some of the most amounts of money to fund the war once the U.S. was part of it. And they also ran a lot of the money for Reconstruction after the war. And again, I'm going to go through the 20s really quickly. But after the war, of course, there was a period of... Is it like a time or something? It's like, no, really go quick. So through the 20s, what happened after the war was that the U.S. underwent a very strong streak of isolationism, and protectionism. He's on pay. As well as deregulation of the banking system. Those are the three things it did. And what that meant was banks, not just Morgan, but Chase and National City Bank, which was one of the other three, which we now know as Citigroup, which you know here as Banamex, basically became much more sort of powerful because they went to the various other presidents after Wilson, Warren Harding and Calvin Coolidge, and said, we really don't want any rules. We helped you. We need you to help us. We need to make sort of more money sort of in the aftermath of this war and sort of do it in different ways. And that's when a lot more speculation, of course it's now 20 years after the panic, started to come into play. So by the late 20s, there are very few rules operating with respect to a lot of these larger Wall Street institutions. And they started doing what the brothers had done that had led to the Knickerbocker Trust Company debacle, which is they started creating these things called trusts, and into them they would stuff real estate bets and various stock shares and all sorts of other things into one sort of mix, and they would sell them to people. And when you mix a lot of stuff that only has confidence or stories about it or sort of very nefarious types of data to indicate its value or its potential future solidity into one place, and you sort of darken the security that's the result, and you tell people to buy it, and more people buy it, when there's a problem, The sell comes very quickly, and it's very painful for all those people who got involved. And that's exactly what happened in the crash in 1929. Not only had people who had never bought stocks started to buy stocks because they could only go up, but also they started to buy into these trusts, and companies started to buy trusts, and pension funds at the time started to buy trusts, their rudimentary forms, and they started pushing the value of these things up even though they weren't really valuable. And so what wound up happening was, in the fall of 1929, is there was a big stock market crash. Now, the same bankers or their descendants who were involved in that whole panic of 1907 and are sitting in a room next to the stock exchange, next to the New York Stock Exchange, literally next to. The Morgan Bank is like from me to the end of this room, away from the New York Stock Exchange. And there's a stairwell in the back of the New York Stock Exchange. There's shares going down, and there's bankers in a room basically across the back side of the street trying to figure out what they do now. You know, we have a Fed, yes, but this is going down pretty fast, and our own shares, like our bank shares, are involved in this major crash of confidence and people selling and selling and selling. Lots of stories to that. So what one of them does is he manages to convince the other 6 in the room that they will pony up their own money this time. Like, they don't have time to deal with the Fed. They don't have time to deal with Washington. They're just like, we're gonna each pony up $25 million. We're gonna go in there. We're gonna buy shares, because if we buy shares, other people are gonna buy shares. Everything's gonna go up, and this will all have just been like a bad circumstance, and we can go on as we were. So one of the runners goes, and this is incidentally just a separate fact. I do see NBC off and off of the stock exchange, and the way to get to the back end where the makeup is now, there's a hair and makeup spot on the back end of the New York Stock Exchange, and you actually have to take the same stairwell and the same sort of back way into the exchange to get in there, to then go on to the stock exchange to shoot the segments that CNBC does at 4 o'clock, called the closing bell. So anyway, these things again remain historical. So shares are being bought. Market does go up for a minute. Goes up for some days. Goes up for a few weeks. Goes back down. Goes back up. And all of a sudden, everything, the bottom completely falls out, because it's discovered that these trusts don't actually have anything real in them. There's no money around to buy the extra shares. A lot of these bankers were sort of manipulating their own shares, so that's still going to be discovered. There's a lot of tax evasion going on, and all sorts of crime that's basically happening as the system implodes in the crash of 1929, which of course leads to the Great Depression a few years later. But all throughout that period of time, these major banks are really sitting on their own protection. They're sitting on money. They're not helping to lend it out. They're not now helping small businesses. Businesses are closing. 1 out of 4 people in the United States doesn't have a job. There's all sorts of dire straits throughout the country, particularly in the middle of the country, which supposedly was going to be helped by, for example, a Federal Reserve that would parcel out the money evenly away from the Wall Street Center, which it hasn't and doesn't do. And as a result, there's one guy. Well, there's a lot of people, but there's one guy in particular on Wall Street who works at a firm called Goldman Sachs, where I worked, named Sidney Weinberg. And Sidney, whose nickname was Mr. Wall Street at the time, basically says, I kind of know what to do here. I'm going to help to elect another president. I'm going to figure out how to remake the sort of validity and the reputation of at least my bank by sidling up to Washington. So he decides to raise money for a guy named Franklin Delano Roosevelt, and he actually gets a lot of business people to do the same thing, because at this point the climate throughout the country is pretty bad. It's bad for businesses too. Everybody's suffering. People on the ground, people, even the top. So he says, I'm going to get a bunch of business people together. I'm going to collect some money. I'm going to run this guy. Now, there were other people in the country who wanted, there were Democrats in here who wanted Franklin Delano Roosevelt, of course, to become president, who thought Herbert Hoover had done like a crap job, although, frankly, it was really the presidents before Herbert Hoover who had created the mess and allowed it to happen. He just happened to have been there when it all fell apart. But having a major player on Wall Street push Franklin Delano Roosevelt helped him raise money. One of the other people that helped him raise money was actually JFK's father, who was out in California raising money, as well as on Wall Street raising money. He was ultimately rewarded by FDR when FDR became president with becoming the first head of the Securities Exchange Commission, which is the commission designed to to look at fraud as it's happening throughout the system and throughout banking. But at the time, they were both raising money. FDR gets in, I'm summarizing, it's in the book, and tries to clean up and really stabilize what's going on in the banking system in particular, and of course with Reconstruction throughout the rest of the country. With respect to the banking system, he actually takes up something that Herbert Hoover had started and failed to pass, which was an act that would take the speculation out of banking and return these banks to a position where they could choose whether to take people's deposits and provide loans, or they could create weird trusts and other types of securities and speculate and do what's called investment banking business, but do it on their own dime. Not ever have a United States government backing, not have the Fed backing, just do it on their own dime. And they could make a choice. And the act that was ultimately passed that allowed this separation, required this separation of banks to happen, was called the Glass-Steagall Act of 1933. Now, someone mentioned I worked with Bernie Sanders. He was one of the people, ultimately, I'll bring him back in the story, who is currently trying to get the Glass-Steagall Act back. It's been repealed since. But in 1933, it was passed, and it was passed by people like Sidney Weinberg actually pushing it, by bankers pushing it, and by one particular fellow, Winthrop Aldrich, whose name is really kind of lost in history, but he was the head of Chase at the time. And he actually worked with individual senators and individual congressmen within Washington, not as a lobbyist, but as someone to convince them that we needed this separation in the country. We needed to divide out the betting from the solid, vanilla, prudent banking. And so he was the ones, even though he wasn't in Congress, so his name's not on this act, but he was very, very vocal in pushing internal politics in Washington, which has always been hard to do. It's harder now. But to move it forward to create a more stable economic and financial system for the country. And he was very effective, and in fact, he was so confident in his effectiveness that he took out a front page headline story in the New York Times to say that he would separate his bank, Chase, into two pieces, into a piece that just dealt with vanilla banking, just dealt with deposits and loans, and into a separate piece that just dealt with bets and various forms of speculation, before the Glass-Steagall Act was even passed. Which, you cannot even conceive of Jamie Dimon, who is the current CEO and chair of JP Morgan Chase today, to even contemplate in his just darkest nightmares doing that to himself. But Aldrich did, and he actually got a friend of his, James Perkins, who was the head of National Citibank, which is now Citigroup, to do the same thing. So they basically told their shareholders, look, this is what's going to happen. We're going to split up our banks before legislation occurs to make us do it. We're going to be fine. We're going to regain confidence in the banking system. This will all work out for us later. And as we know, decades and decades later, it worked out very well for them. Well, Winthrop Aldrich effectively became a legacy head of what is now the largest bank in the United States. He took over JP Morgan in the process, so JP Morgan Chase, even though the name JP Morgan is first, effectively it was a Chase takeover. And so he did that over the years, but at the time it was a collaboration of people who needed something different, of bankers who understood the concept of stability, and of a president who had the vision to connect the two and to move forward in such a way that at least the finances of the country, of citizens of the country, would be secure. And as a result of the Glass-Steagall Act in 1933, we really didn't have another bank crisis until it started to be dismantled. And until various different groups and people, and it was on a Republican and a Democratic side, tried to take little pieces out of it. First in the 80s, it's like, well, why don't we let banks, instead of just dealing with their local or regional customers, let them go across state lines? Why don't we have ultimately credit cards located in states that don't have as much transparency? Lots of other things happened along the time, but it wasn't until under Bill Clinton in 1999 where the Glass-Steagall Act was totally repealed. And in the act that repealed the Glass-Steagall Act, which was called the Financial Modernization Act of 1999, it wasn't called Glass-Steagall repeal, there was a whole bunch of other stuff that was thrown in there in this act. All the stuff that gets thrown in, as it still does in Washington, got thrown in late at night. And some of the things that got thrown in was things like banks don't have to be transparent about the certain esoteric types of securities that they're now going to create. And by the way, with Glass-Steagall now repealed, they can create them right in the same building as they're also taking people's deposits to back the risky stuff they're creating. So they basically did all of this in one fell swoop. One of the people who voted against this, there was 90 to 9 senators who voted for the repeal of the Glass-Steagall Act in 1999, was Senator Sanders, and also Senator McCain from the Democrat and Republican side. And they are actually 2 senators now that have their names on an act to resurrect the Glass-Steagall Act. There's just a lot of they're pissed. Like, we should have this back yesterday. And I'm gonna let them talk for a bit. No, but the result of that repeal really was what caused the financial crisis of 2007-2008. So a century after the Panic of 1907 set off a whole chain of relationships and actions and entities being created and things, acts being created and then repealed happened, we have this major financial crisis. Why do we have a major financial crisis? It's a full other book. I wrote a book called It Takes a Pillage, which describes it in great detail, which came out in 2009. But the pillage part was that these very same institutions that had at one point screwed up, had backed away, had advocated for stability, and then started to push away at it again, were really at the center of this financial crisis. It wasn't really the mortgage banks. What the mortgage banks did was give out loans. What the big banks did was buy them, package them, knew how they were performing, and sell them in little pieces throughout the world, to pension funds, to legitimate insurance companies, to municipalities, to community banks, to individuals who were basically pushed to buy certain pieces of the stuff without even knowing it, because they were wrapped into different types of securities that people didn't understand what was in them. Pension funds didn't understand what was in them. So as a result, there was about $14 trillion worth, that's about the GDP, a little less, the equivalent GDP of the United States, worth of these assets that were created off of loans that these institutions knew very well were failing. 60 to 70% of the specific loans they selected to go into this $14 trillion pyramid of toxic assets, that's a big sentence, 60 to 70% in advance they knew were already failing. Why do they know that? Because when you're sitting in a bank creating these things, and I did it back when there were, Dad, you'll know what these computers were called, but in the 80s when they were like big, ginormous, gray boxes and rooms and stuff, and looking at pieces of paper that translated what loan came in and how much money came in and whether it was paid and what came in and whether it was paid, to when it got much more technologically efficient, is that the big banks know exactly what money is coming in and what money is going out. They're very, very good at that. They know exactly what's going on. And so they knew from the get-go what they were putting into these toxic assets, and they did it anyway. Why? Why did they know? How did they know? Because they were post-Glass-Steagall repeal sitting on their books. They're right there. It's not like they have to ask another bank with loans how those loans are doing, because they have those loans. They've bought those loans. They're in their environment. So if they want to create in a different office with much more higher paid people, because the people that create the stuff make a whole lot more money than the people who check the numbers at the bottom in any institution, all they're doing is getting data in and processing it into new securities. And then they're going to a rating agency, which they are still doing, and saying, look, we have all this stuff. Really, mortgages never go down. People always want to pay for their house, and we have all this stuff, and collectively, it'll all work out. Rating agencies are, okay, that sounds good, and they would rubber stamp these toxic assets, as we later call them, and these new securities, with an okay, with what was called the AAA, the highest possible quality for this crap, and move it along. And what that meant was banks who were even more conservative, pension funds who were more conservative throughout the world could buy them because it was buying a grade A type of security. They didn't look beneath it and determine whether or not it was going to fall apart the next day. But from the beginning, 70% of it was destined to fail, and that's before things got bad, right? So it's And there are graphs and charts for all this now at this point. At the time, it was just sort of developing, and people like Ben Bernanke, who was running the Federal Reserve at the time, was saying things like, oh, there's a little bump in the housing market, it's no big deal. And why it was a big deal was because it wasn't about the housing market. It was about the financing and the assets that created on top of what was going on in the finance market. It was magnifying any problem that could possibly happen by many, many, many times. And so as a result, when things completely fell apart and when we had a financial crisis and when my former boss, Hank Paulson, was on his knees before Nancy Pelosi in the House saying we need to bail out these banks, otherwise they're going to stop giving cash to all of their customers and there's going to be an even bigger crisis. And she said, okay, fine, I'll get that passed through the House. And the Federal Reserve said, okay, fine, well, we'll lend you extra money because now you're backed up by the U.S. government with this bailout, so now you're kind of good for it, so we'll loan you more. And this was just happening in the beginning of the financial crisis. This was just what was going on in the beginning of 2008. As the decade passed, as we are now, this process of allowing these larger institutions in the United States as well as throughout the world to sort of float on central banks giving them money effectively to allow them to appear healthy has become just normal policy. It's become normal what's called monetary policy. That's why rates are so low in the United States. That's why rates in Mexico were quite low. Actually, the Central Bank of Mexico is pretty good about this because they obviously there's a very strong relationship between Mexico and the United States from a trade perspective and from a history perspective. But there was also, a sort of Mexican independent spirit coming from the heads of the central banks of Mexico, and this is sort of getting into my next book, but just as a preview. By the time Agustin Carstens, who is now leaving his post as the head of the Central Bank of Mexico to become the president of the BIS, which is the Bank of International Settlements, other long history, created in 1931 in the middle of the Depression as well, but it's the central bank of central banks. It kind of is the place where they all talk and hang out and that sort of thing. So he's actually going to quite a solid position globally, which is good for him and actually for Mexico. But he and his predecessor decided that much as they had to do what the United States was doing from a policy perspective, they also had to, and you know this as well because it's not been exactly done 100%, but to protect the peso. So on the one hand, if they lowered rates too much, it would be hard for people here to keep money and get any interest on their money. And that would be bad for the peso as well. It would be bad for capital staying in here. It would be bad to preserve foreign money here. But that's what the U.S. was doing because it could, because it was bigger. So the U.S. dropped rates to zero. Europe dropped rates to negative. Japan dropped rates to negative. So all the biggest sort of G7 country central banks followed the Fed. I call it colluded with the Fed to make the cost of money zero, not for people, but for banks to continue to have access to cheap money so that they could operate. Because in effect, they're not as healthy as they appear from things like their very high stock prices right now, because they're using a lot of this cheap money to do things like buy their own stock, which is a legal way of manipulating their stock up, and that's one of the reasons why the stock market is so high. But in Mexico, there was a little bit of a different tactic, which is that because there's slightly more inflation here, because there is an independent economy, even though it's a very connected economy, and because of that sort of spirit, there wasn't as much of a decline in interest rates when the U.S. was requiring some of the other larger countries to do what it was doing to keep sort of money flowing at the same cost, at the same level, at the same return throughout the world. And that's sort of been a positive here. And whoever becomes the next central bank head, it's pretty plausible, specifically also because of the relationship that our person in the White House has with Mexico. It continues to develop with Mexico in that way, that I think that independence will continue to reign. So what started as a simple worry that what the Fed was doing in the wake of the financial crisis was simply helping the banks too much and reducing the cost of money so much that it was causing things like these bubbles in the stock market with companies and banks buying their own stock and not really the value of things changing, just them pouring this cheap money into their own share prices, that they instead would step back from that a little bit and develop alliances with other countries. So as a result, of that initial worry about U.S. policy causing financial bubbles throughout the world, and that keeping of certain independences, Mexico has really been developing a lot of alliances with countries more quickly than they had before both the crisis, the Fed's response to the crisis, and since Trump was elected president. And among those, and actually I was just here, I was giving a talk in Mexico City in May, actually, in the earlier part of the year at the Tech there. And I was talking about NAFTA and that sort of element and some of this, the banking concepts. And right after I was going to leave the room, where I was talking to a bunch of people from the government and academics and so forth, there was this delegation from China who was waiting to come into the room to talk about how they were really going to work with Mexico on infrastructure projects and development and sort of better international trade. And that's a very large, powerful economic country, but it's happening with other countries as well. The relationship with Mexico to Mercosur, the relationship with Mexico to Japan. A lot of the meetings that have happened historically have been accelerated, and a lot of the results have been accelerated in the wake of what I believe is two things. One is the way in which the financial crisis happened and how it was handled, which is that the banks weren't changed in any way and they're still being effectively coddled by monetary policy that's orchestrated by the Fed. And the fact that as a result of that, the economy isn't perceived as that stable for the majority of people, and as a result of that, it causes political decisions. It causes people to vote for Trump. It causes people to vote more conservatively in Europe. It causes people to vote for Brexit because they don't, because who do you blame? You're not going to blame some esoteric sort of dark money entity like the Fed or like the European Central Bank, the ECB, or the Bank of Japan, the BOJ, because you don't know what, nobody talks about what they do mostly. I mean, that's not really attached to your day-to-day, purchasing of groceries, or your receiving your pensions or your retirement investments or whatever. It's kind of in the ether. But the feeling of economic insecurity is prevalent. And so that changes political decisions. So if you take the result of a financial crisis and a Federal Reserve reaction to it on a global basis, and you add that to the economic instability that is not fixed by those decisions and by those events, and it translates into political choices, you have a situation where countries outside of the United States and people within the United States remain less secure about their financial futures and wanting to find ways to be more stable, to have more real growth, to have wages be raised higher than a level of inflation, to have retirement money go further, to have Social Security mean more. And so all of that still exists. And that's created this divide within the United States. That's created this turning of Mexico and other countries towards each other and away from the United States. And that's simply exacerbated by a guy who tweets whatever pops into his brain at 3 a.m. Relative to any country that happens to pop into his brain at 3 a.m., like Mexico, North Korea. And so all of that together, I think, will create a situation where economic instability is still prevalent, but again, countries are looking for ways to rectify that outside of its main cause. And within the United States, we're also trying to do things as well. I spend, not only like Winthrop Aldrich, a lot of time in Washington talking to Congress people on both sides of the aisle about our need for, at the least, financial stability going forward. We all know we bailed out banks. We all know that money is cheap and it's created an exorbitant amount of stock buybacks that has manipulated and bubbled the stock market to levels that look good but aren't real. And we all know that there could be another crisis if you don't fix the last one. If you don't fundamentally alter the structure of the foundation of a building and you have another earthquake, the building's not going to do better the second time around. And that's exactly what's going on now. So I spend a lot of time in Washington trying to explain this to people. It's not a partisan thing, but it unfortunately there is a ton of partisan politics, as we know, that what in Washington. It always has. It's gotten worse, although there are a lot of Republicans who really truly don't understand what Trump is doing any more than Democrats do. But the idea of, for example, bringing back a Glass-Steagall is something that does gain traction. I'd say right now, given that it was both on the Republican National Committee platform as well as the Democratic National Committee platform, even though the definitions of, say, bringing back Glass-Steagall or a modern-day Glass-Steagall or a 21st century Glass-Steagall differ amongst people, that the intent was there on both platforms. And so I just sort of take the fact of the intent with the problems and the structures of banks that have continued to exist and that are actually getting worse right now. There are certain things that are just as bad in bank books right now as they were leading up to the financial crisis. They just call certain securities by different names because they can, because no one checks. That there's willingness to at least hear it out. Like two of the people I deal most with in the House is Congresswoman Marcy Kaptur from Ohio, Democrat, and Congressman Walter Jones from North Carolina, who's a Republican. And Walter Jones voted for the repeal of Glass-Steagall in 1999. He was in Congress back then. And he says it was one of the two worst decisions of his career in politics, the second being to vote for the Iraq War. And he's been trying to really do good by that decision. And so he and Ms. Kaptur have a very strong alliance. There's actually a bill called H.R. 790 in the House right now that's co-sponsored by a Republican and a Democrat that has, I think last count, 60 co-sponsors. I think the last person who signed on, I was actually in their office when this happened, was Congressman Soto from Florida. And so there is enough of a buzz. And what can people do? And this is just one issue of many, but our financial stability impacts so much of the rest of the economy and our relationship with the world. And when I say our, I mean the world to the world. I just don't mean whether you come from the US or Canada or the UK or Holland. I mean like all of us, is getting some of this stuff right. And so it does help from a voting perspective. It does have meaning to bother congressmen. I used to think it didn't have meaning. But it does. It has meaning because they're doing like a lot of stuff, and so they will handle or ignore whatever is in front of them at that moment. And if you sort of bother them enough, they can continue to ignore you, or they can try to handle it. And so it does matter what any registered voter does with respect to action and their Congress people. Many people don't email their Congress people, and it's or write letters. Writing letters are actually more effective because there's still a physical presence there. But it's also important to email. You can even tweet. I mean, this is something where everyone actually does have an ability to make a little bit of a difference with their Congress people or with the people they are friends with in their own countries or back home. And this is kind of an item that's going through Europe as well. There's an equivalent to a sort of Glass-Steagall reinstatement in the UK. There's an equivalent in Italy. I mean, there's different places where the idea of at least stabilizing how our money works and where it's protected and where it's used to back bets divides. And so that's something that I keep doing, and that's something that you guys can certainly help with. There's things we can't necessarily change, like Trump waking up and tweeting whatever pops into his head at 3 a.m. While he's still there. But there are ways that we can actually, look at these financial issues because they do impact all of us, and sort of get involved as well. And that would help me, that would help you. And so it's just another way of bringing sort of community together from wherever we are throughout the world, and us just sort of working collectively to help each other. So with that, and I usually end much more depressingly, so that was actually, I was kind of hopeful. It was the birds, so they're sending out a little sort of message throughout the world right now, like they used to do. But I do want to thank you guys all for coming out here. I know I sort of covered a multitude of topics, and there's probably a lot of stuff on your minds individually and collectively. So I want to just thank everyone again. I want to thank John and Mona and Antonio and like everyone who came here today, and my dad for giving me life. And my stepmom Marguerite, who has given me so much since we've known each other, and I think all of you know both of them. My lovely boyfriend Nigel, who has made the trip here to see all of this and be by my side. And again, I just open it up to questions and comments, and I hope you do buy my book as well. It's not here, but it is on Amazon. The next one will be on Amazon too. It's called Collusion, again, and thank you.
Testing 1, 2. I don't know anything about the bond market, but I had been reading where they, who said irrational exuberance?
That was Greenspan originally.
Greenspan, sorry. And he was saying that he thinks that there's a bubble in the bond market, and so I wanted to know if you have any opinion on that.
So this is interesting, because Alan Greenspan, who actually had worked as an advisor and was on the board of J.P. Morgan at the time before it became part of J.P. Morgan Chase in the 80s, and was the head of the Federal Reserve before Ben Bernanke was the head of Reserve, before Janet Yellen, who's now the head is. He was very much a proponent of deregulation of the banking system. So here's a person who runs the institution that theoretically, according to its mandate, is supposed to regulate the banking system, opting for deregulation of the banking system, which isn't weird, it's ironic. But he was a proponent of derivatives trading and a lot of the types of more esoteric practices and different types of securities, more complicated than bonds, that were created by Wall Street, pushing Glass-Steagall repeal, and since then. And for him to come out, and I agree with Greenspan, for him to come out and say, you know, this might be a precarious position we're in. I mean, all this money being created, and the Fed has basically created $4.5 trillion, created, just fabricated, $4.5 trillion of money, of fake money, of dark money, into the banking system. They say economy. It's been fabricated. It's gone into the banking system. The European Central Bank has also fabricated $4.5 trillion worth of cash. The Bank of Japan, another $4 trillion. The Bank of England, about $600 billion. There's a lot of just fake money that's infused the financial system. And what that does also is it creates an atmosphere where bonds are very easy to issue. It's very easy for a company to borrow money and not pay any interest for it. And that's the result of rates being very, very low. So if the Fed's creating money and it's using it to buy bonds and securities from banks, so it's saying, here's cash, give me the junk you have, and also some treasury bonds, also some government bonds. We'll just create money and we'll hold them. It creates a situation where rates are very low, which means that someone who is issuing a bond doesn't have to pay a lot of interest, as I said. That will create an environment where everyone wants to issue a bond. The biggest companies have issued the most amount of bonds, and they have to pay the least amount of interest to people who buy their bonds or effectively lend them money. If the U.S. Treasury creates Treasury bonds, which it's created a lot of since the financial crisis, it was $5 trillion before the crisis, it's $20 trillion now. That $15 trillion, in an environment where rates are very low, where the Fed has kept the cost of money very, very low, because it's just creating it off the top, means that even the United States doesn't have to pay a lot of interest on the money that it's being loaned by China, by Japan, by whoever's buying treasury bonds. When so much is happening so easily, it creates a bubble. Because it means that the money going into the bond market is coming in from a place where it just doesn't have a lot of value. It's just pushing up the price of bonds. And it doesn't mean that the companies that are issuing those bonds are necessarily more healthy. Banks, people, investors aren't buying those bonds because their companies are doing well. They're buying those bonds because they have nothing else to do with the money, and it's coming to them cheaply. So what do? But it doesn't necessarily change the value of those companies. So when Greenspan or anyone says there's a bubble in these bonds, what he's referring to is this idea that the bonds themselves are going up not because they should, just because people are buying them, because money is cheap, and because there's nowhere else to put it. And at some point, you get to a situation where even the companies that are barely paying interest because they don't have to, given the level of money in this market, start to have problems paying next quarter's bills, or start to have problems paying their employees, or start to have problems paying into their pension funds, because pensions aren't making any money either, because they used to be invested in bonds that on average were high quality, not risking return 5 or 6%. Now they return like, you know, 0.5%, same bonds. So it's affected everything along the way, and at some point the companies who are issuing this debt, when they start to have problems, that's when these bubbles start to break. Because when they can't even pay that a little amount of interest, and there's nowhere else to get it, and there's nowhere that money can go any lower, that's when those kinds of bubbles pop, and that's what he's referring to, and I totally agree with that. I think that's in the stock market as well.
Two quick questions, if I may. First, thank you for speaking to us. And considering the amount of American debt that the Chinese and the Saudis owe, as you referred to him as the person in the White House did something erratic, causing them to cash in their debt, what would it do to the American economy? And second, considering the power that the banks and insurance companies, whatever, have on domestic issues, and the power that special interest groups like AIPAC and others have on foreign policy, is America still a democracy?
That's a really good question. So let me start at the beginning. I'll go through your question. So take China, right? China has about $1.1 trillion of our debt. 1.1, 1.2. Japan has about the same. So what that means is they lent us money to do stuff because they believe in us, because they need to have treasury bonds in their central bank, in the People's Bank of China, in order to use in case they need to buy or sell dollars. And the thing about that is they have, it's like a catch-22. If they were to sell too many of our treasury bonds, yes, that hurts our treasury bond prices because you're selling, they're coming down. But it hurts them as well if they do it too quickly and just basically too quickly, because they're then depreciating the value of their portfolio. You know, it's like if you're having a garage sale and all of a sudden you sell all your old tires, you know, there's no value for the tires you have left. Everybody's bought all the tires they need to buy, they're done. If China decides to sell its bonds quickly, and this has been the case for a while, this is why whenever there are stories about how that could happen, you have to consider that on the other side, they need to put something else instead. Now they are starting to. They've been buying more gold. They've been trying to incorporate their own currency, the ren, into more global trade. You know, I was saying before, you know, by developing more trade alliances and more currency alliances outside of the U.S., it's a way of doing that around the back without necessarily hurting their own stock, their own portfolio of treasury bonds. What that means is their ability to impact us does exist. Us, I'm in Mexico. Their ability to impact the U.S., and I know you're from various different places, their ability to impact the U.S. happens more slowly. And their interest in doing that is to take this opportunity and time and in politics to, you know, elevate their own both economic and diplomatic power. It's not just China, it's many countries. So that's where there's a timing issue. In terms of whether the U.S. is a democracy, the reality is, if you look at it from a financial perspective, there's an awful lot of money going to an awful lot of politicians from an awful lot of companies and interest groups to buy policy. And you know, you take the banking sector, just because I've been talking about it, it's one of the largest flows of money, both from lobbyists and from the institutions themselves for policy. And it also has, I forgot to mention him before, Steve Mnuchin, who worked with me when I was at Goldman Sachs as well, is now the Treasury Secretary of the United States, who decided recently, and because you mentioned insurance companies, that AIG, which was really was kind of a trading company. It was there to guarantee a lot of the crap the banks were effectively creating into the financial crisis, as a result of which it almost went under, as a result of which we had, a component of this bailout that went to all the banks that were involved. Steve Mnuchin has basically just sort of deflected a rule in the Treasury Department that he could actually get to that says that AIG is now okay and that there doesn't have to be as much transparency over the reports that AIG was providing over these exact types of insurance policies for these exact types of securities as the other time around. So on the one hand, there's the buying of policy. On the other hand, there's the positioning of these people who have their own interests and come from these worlds into positions of extreme power, who also then create policy or sort of loophole policy as best they can. And that is definitely a crack on democracy. And this is where I talk about, where do we have democracy? We have democracy in our vote, we have democracy in our voice, we have democracy in our opinions, we have democracy in collecting our opinions together. But there has definitely been a shift. When you have a shift in equality of power and equality of policy creation, inequality of wealth, and equality of accumulation, that by definition impacts democracy, and it's happened more quickly and more acutely in the United States. It's been for a while, but in the last 10 years than at any prior time in the history of the United States.
Quick question. Why does it appear that J.P. Morgan is repeating the Knickerbocker experience, but they're doing it with silver instead of copper?
No, that's a very good point. What he's referring to is, so there's the idea of, well, there is the fact of fiat currency or currency that's fabricated by central banks that goes into, in this particular decade, the banking system itself, that's gone more directly, sometimes it's gone less directly. And then there's the idea of hard currencies or sort of equivalents of currencies like gold, like silver, that have been around for much longer than this type of currency, than paper currency or now electronic currency, that have kind of stood a test of time and exchange value. And as of 1971, of course, the gold standard of having a peg of the US dollar to gold has gone away, which was pushed, this is also a good chapter in my book, which was primarily pushed by banks because it was easier for them to get money from the Fed than to have to deal with finding gold and preserving gold. I mean, it starts to get expensive to keep, to mine, etc. And so it's much easier if money can be created for them electronically or printing at the time and now electronically. And with silver, a similar thing has happened in that there's been markets that have evolved to electronically trade gold and silver. So it's like you don't have to physically own gold to trade gold. You don't have to physically own silver to trade silver. You can just sell or buy it on futures markets and never have to touch it, never have to sell it, never have to own it. And in a large extent, J.P. Morgan was involved because they're involved in a lot of the funds that buy and sell silver. This is part of having Glass-Steagall be repealed, that these banks can create funds and buy and sell into these funds. So it's another way to sort of manipulate the prices of things in the market, calling it something that their customers want. They want investments. All we're doing is buying and selling investments in funds. We're cool. But as a result, they've been able to find places to short silver and keep the level of silver depressed, simply as a way to not allow it to have the kind of value it would have as a hard asset, to even have the possibility of being some sort of a peg currency. Now, I don't believe that silver would actually sort of become a currency or a part of a currency, a part of a peg. I think there's more of a possibility that gold would become part of a basket of securities that could be used as a single currency at some point, which is a longer conversation. But JP Morgan found that they could do this by effectively selling paper silver while people were buying real silver, and doing exactly what the brothers were doing with copper back in 1907. It's just the relationship today between JP Morgan Chase and the US government, even back then, started back then, is far tighter than the relationship was with any smaller company trying to corner copper back then. By virtue of the fact that, as we saw, the companies involved went under. J.P. Morgan Chase is the government. I mean, a lot of the financing that goes in and out of different departments of the government goes in and out of J.P. Morgan accounts. I mean, Barack Obama had like $1 million or so of his own money in J.P. Morgan accounts. I mean, they are actively connected to the government. So what they do too often tends to be hand-waved. There's a suit right now, not related to silver, but just because I'm on J.P. Morgan, where the money that J.P. Morgan had to pay in settlement on the fraud it created in mortgage-related assets during the financial crisis, some of that they are actually using from mortgages they don't own. So they're actually paying their fine for mortgage fraud with interest from mortgages they don't own. Now, like, there's a suit that literally just started in the last couple of weeks because a bunch of sort of companies that are like, wait a minute, but we own the mortgages, are getting upset, and they've launched a major suit against J.P. Morgan. But you know, there was no, it's not like Trump was going to be like a 3 a.m. tweet about, you know, J.P. Morgan, how could you do that? So there's a certain coverage also that bank in particular, any of the large banks, continues to have.
Yeah. I just wanted to ask kind of a personal feeling about all this. Like, I have a small stash for my old age, and I've got it half in a credit union, half in a bank. And I hear all this talk about Bitcoin and, you know, our dollar's going to fall. And I just wonder if you have any suggestions for a safer place to put it. Or do I need to buy land?
Actually, yeah, that and a good mattress. No, Bitcoin is something, or cryptocurrency is something that's very popular now, and it's probably going to be popular for a while. I don't personally feel it's very safe. I don't personally advocate, unless it's as like an investment at the tail end of investments, where you just want to take a bet as to whether or not it's going to be more popular in the future, which it quite possibly might. But in terms of actually preserving the capital you need to live from, I don't think it's a safe place. It's not really regulated, although individuals who are pushing it, or companies that are and are seeing more activity in it, you know, tend to talk about how it's regulated more now than it was. But it's not regulated enough for me, so I wouldn't advocate that, again, unless it were like a side bet. In terms of where you put money, there is a certain value attached to putting it, if you have to have it in a bank, in a community bank, in a credit union, in a regional bank, because the idea of that is it helps your community. And if there's a small business in your community, like here, I mean, whether it's cash or whether it's money that you have from running this place and all the beer everybody's going to buy later, whether that's in a bank or whether it's a way to help, you know, what's going on near you, and that helps solidify what I call the foundational economy, and that helps people in your community, you know, in your city, in your state, or whatever. So, and that ultimately helps you, because that just means there's more that's happening around you, and that sort of gives a value to your location. So I do believe that if you have cash, and usually they get, even though rates are crap right now, that if you have cash, usually credit unions provide a better rate for your cash, because they want to be able to use it, they want to help you, whereas a bank like Chase really doesn't care where it gives loans or whether it gives loans to small businesses or not. It's all part of a much larger picture. So if you have cash, that is a good place to put it. If you live somewhere, if you pay off debt, if you just have liquidity, that's another way to make money work. If there, and I don't know what your debt situation is, but you know, a lot of times the rates that you're paying on debt are very, very high to what you're getting in return for keeping it in a bank or keeping it somewhere else, and that's a cost. So one way to place money is to actually sort of reduce that cost, which is what companies are doing. So it's sort of just doing the same thing, but doing it on a personal basis. I think land in places you live are good too. I think things that you use, that you actively use or that your family uses or that, you sort of our hard assets are a better place to put money than say in a market or say in a place that you're not getting a lot of return for. That's where you keep the liquid money, but the rest of it you keep in things you use.
We'll take a couple of more questions. If some of you need to leave, feel free to leave. I know some of you have other commitments. But we'll take 2 or 3 more questions, and then Nomi will also be available after we close formally. But we'll take 2 more.
Thank you again for coming. So, quickly, a portrait of human nature, since it tends to repeat itself, and history seems to be happening. Just a summative comment. When's the market correction going to happen? How serious will it be, and when do you see the consequences? Thank you.
There you go.
It's a very good question. The birds, no. Here's the thing. The level of collision between the central banks is super high, and it has been for a decade since the financial crisis. And what has happened is this whole pushing of creating money, buying bonds, keeping the level of interest low, allowing therefore companies to borrow more, to buy their own debt, to buy their own stock. All of that bubbled, and all of the policy that creates that bubble, it has very strong power attached to it from the standpoint of the central bank institutions and their relationships with both the private banks and the various governments that don't really want to see markets implode under the sort of individual watches. And as a result, what I used to think I thought the markets were going to crash in 2011, 2012 because things weren't fixed, because the banks were still piled up with bad assets, and that was before they started issuing a lot of new bad debt and new bad loans. And that was when there was a crisis in Europe. And that was when there was a real fear throughout the collective G7 central bank community that something had to be done. And they did it. And as a result, there was no major crisis. The same thing in the middle of 2015. There was sort of a crisis coming out of Asia to a small extent. And then there was sort of a remedy by these same central banks, and they fixed it. So the question to me is, can they keep fixing it? How long can they keep fixing it? Because there's no doubt there will be, to me, another crash because nothing's been fundamentally fixed. And so going back to when that will be, another thing I used to do is determine, well, if there's a program that a particular central bank has, like the ECB says they're going to stop buying bonds in mid-2016. So I'm like, okay, they're going to stop buying bonds. That's another potential date to look for. There's going to be less money going back into the system from these institutions. It's going to start to implode. All these cracks will start to happen. And what did they do? They got to the middle of 2016 and they said, sorry, we didn't really mean it. What we really meant was 2018. And so the time keeps going out. So right now, I feel that there's no real indication from these central banks that they are going to fall apart in their collaboration anytime soon, which means that we continue this sort of nefarious bubble position for possibly a while. A year or 2 years. I don't know what the actual date is, but until there's a substantial change in the structure of any of these institutions relative to each other, which could come from a geopolitical perspective, it could come from banks having a large mega trade on that's international that could fail again. But until something happens externally, they've got a pretty good lock on the status quo right now.